Affordable Medicare Solutions is Georgia's leading educator on choosing the right Medicare plan and individual health plan for you. Hello, my name is Keith Nabb. Thank you for attending today. We're going to talk about succession planning for Medicare and health insurance agencies. Our presentation is called Grow, Protect, Exit, and it is an overview on agency protection and succession planning, including emergency succession planning. About us. My name is Keith Nabb. I'm the founder and principal of Affordable Medicare Solutions. We are a Medicare planning agency that is about 20 minutes north of Atlanta, Georgia. Our claim to fame is to be the best Medicare planning agency in Georgia, and we've been named that 4 out of the last 5 years by the largest insurance company in Georgia. Now, we are a pioneer in acquiring, managing, and auditing other Medicare and health insurance agencies to help them evaluate their blocks of business. And we're also a pioneer in referral-based marketing. So we do a huge amount of work with other professionals, such as financial planners, elder law attorneys, social workers, anybody dealing with the aging spectrum of senior citizens and their families. So let me tell you a little bit about my history so you can relate it to your own personal situation. I started my business in 1995, and it was a completely different world back then. And then in 2008, an election happened, and we knew there was going to be quite a bit of changes coming to the health insurance industry. So I merged my business with some friends that were in financial planning and other insurance. And in 2012, we dissolved that partnership, and I created Affordable Medicare Solutions. So prior to that time, I was about 80% health insurance and 20% other. Over the time period, that's changed dramatically, and we'll go over that today. But look, from 2014, 15, almost every year on, from that point, I was buying or managing other blocks of business, sometimes mom and pop blocks I would buy, or from corporations where I would take over their blocks of Medicare business to manage it and to own it. This was great and has really got a lot of information that I've learned over these years that I'm going to share with you today. So let me tell you about my block of business, and you can compare it to your own. Today, we're about 80% Medicare and 20% other. About of that 20%, half of that is health insurance. That's growing. So who knows where we'll be in the next couple of years, but that's basically our mix today. Some of you listening today are probably heavy into group health insurance, maybe into life insurance or annuities, maybe financial planning or property and casualty. All of those lines of business are completely different than Medicare, and Medicare contracts can be very confusing. So let's talk about some industry changes that have been happening over the last 15 years. There's an end of generation. There was a whole set of Medicare agents that were pretty much Medicare supplement agents, and a lot of those are in their 70s and 80s years old, and they're retiring out. We have very few younger people getting into this business, so we have a little bit of a problem there. And then there's another problem that we got to sell more policies today to make the numbers work. Shoot, if I was getting paid the way I got paid 20 years ago, I'd be retired. But we've had to roll with the punches. They make changes to our commissions. They make changes to the way we get first year versus renewal and all of those other factors, which means you probably have to have more policies on the books to make your business work properly. Now, there's a lot of disruption. There's been great disruption. COVID, there's been a lot of positives from COVID, such as telehealth and Zoom, meeting with our clients online, not using paper applications anymore, using electronic applications, and CRM systems, customer relationship management systems that have really revolutionized our ability to track and keep clients. But there are also some bad business disruptions that can happen also. So if you talk to the taxi drivers in New York, they have not been real happy about Uber and Lyft. A taxi coin used to be worth $1 million. It's not anymore because there's so much competition. And that happened overnight. Well, same thing happens when we have carrier mergers in the insurance arena. The U.S. Justice Department stopped 2 major mergers over the last 6 years that would have really consolidated health insurance. And luckily, they stopped those so that we have more competition. But then there's competition with agents. There are call centers. There's services such as Health Sherpa and other ones that sometimes help agents. Sometimes they can be a problem. But these are disruptions that we need to learn to deal with and be innovative and work around. So what are some obstacles for agents when they're trying to create a succession plan? Besides all of the other things we've talked about that are just general business challenges, what about if something else happens to you, and how can you help your family avoid last second chaos of trying to rescue your business, and instead you having a good plan to show your family that everything's in a good order, ready to go? So here's some examples. What if you become disabled? You're just driving home from the baseball game and some idiot hits you. Now your business is completely disrupted because you're disabled. Or that idiot kills you and now you're dead. What is going to happen to your business if you die unexpectedly? What if it's not you? What if it's your spouse of 30 years that you need to step away from the business for a while or forever to take care of her? Or what if you're just tired of this industry? What if you just get to a point in your career and you say, you know what, I'm done. I'm checking out. I don't want to learn anything new. I'm ready to sell my business. That happens. I meet agents all the time that tell me they're ready to move on and spend time with their grandchildren. So let's talk about the industry exit strategies. Everybody that I talk to would love to leave their business to their family member or somebody that they can really trust. They really want that. And that's the ultimate ideal. Doesn't always work that way. So internal transitions are the initial gut feeling for people. I had a gentleman who was 83 years old in my office, and I said to him, who's going to take care of your business if something happens to you? And he said, oh, I'm going to, leave it to my wife. And I said to myself, wow, he must have married a much younger woman. And I said, Bob, how old's your wife? And he says, 82. I said, I don't think she wants your business, Bob. You need to talk to her about that. And if it's a son or a daughter, I have 4 daughters. Do they really want your business? I asked my own kids one time. We were playing a game. In between rounds of the game, I said, hey, girls, I have a question for you. Do you want my business or do you want $4 million? And they all kind of sheepishly looked at each other and said, we want the money, Dad. And that's okay. I'm totally fine with that. I wanted an honest opinion because I need to then find somebody who wants this business, somebody that's going to care for it and make sure that it doesn't fade away. So that's one exit strategy, is an internal transition. A part of that to family can be supplanted if you have a key employee that you can transfer it to. Okay. And we'll talk about that also. You can sell your business as an exit strategy. That's fine. And a fire sale is not as profitable for you as a properly structured sale. Or you might say, you know what? I just want to work part-time. I don't want to work all year long. I want to go spend time with the grandkids or play golf. And I only want to work during AEP. There are strategies to help people just work part-time until they're ready to step away. And there's also opportunities, if you structure it properly, under HIPAA and other Medicare compliance rules, where you can actually pay someone to manage your business. On the screen, you see it's called leasing your business, but basically you're paying a management fee to a properly vetted person that you're under a business agreement with so that they can manage your business if you need to step away for a year or two. So let's talk more details about this internal transition wish. That's oftentimes people tell me that's their first most likely thing that they want to do. And that's romantic. I understand totally. But are your family members actually ready to take over your business? Are they ready to sell? Do they even have an interest? Do they even like sales? Do they even like managing people? You have to find out. You have to talk to them honestly about what it takes to be an entrepreneur, to run a business. So the next thing is, a person that really would be good at running your business is a key employee. Let's say you have an employee that's been with you for 10 or 15 years. That would be a perfect ideal target for an internal transition. And maybe they're hoping that you will consider them for that. If you don't have a key employee that's that capable, then you also probably have some friendly competitors, your buddies in the business that you've been to conventions with and other things that you can trust, that you know that they're ethical, good, moral business people that'll take care of your clients the way that you do. Friendly competitors are a great avenue for ensuring your business, because you might set up a cooperative agreement. Say to your friend Bob, hey Bob, if I die, would you take over my business? And if you die, I can take over your business. you can actually set up those type of agreements, but you can't just share passwords and share things with a friendly competitor. That is illegal. And I've run across that many times where people have a person in their office that they think, oh, we'll just share our stuff together, and that's illegal. Maybe your business isn't sellable or saleable. Maybe your business is actually ready to be shut down. I have interviewed some people where I actually evaluated their business, and I said, you know what? Your business has been kind of on the downward slope this last couple of years. I think you ought to just let it expire. Just go ahead and let it bleed out, and you'll be done with it. There's really not something to be sellable here. And you have an honest conversation with someone about that. And it's not uncommon with an elderly agent to have that happen. So if you look at the bottom of the chart there, you see that family-owned businesses operating in future generations is shrinking. Only 30% of first generation, 12% second, and 3% third. And I'm sure that is shrinking as we speak. Here's a major obstacle for all of us, and this needs to be fixed on a national level. But every carrier has a different protocol. There's no standard of how to transfer a block of business. You would think there would be something in the CMS guidelines or government guidelines, and there's not. This is all off the cuff by each insurance company. So they differentiate completely, and they're all extremely time sensitive. Some are ridiculously time sensitive. So I'll give you some examples. Humana, pretty good. They've done a great job with us to help transfer blocks of business, but the succession must take place within 6 months after a producer's death or incapacitation. So let's say somebody had a massive stroke. They might still be alive, but they were incapacitated. Anthem Blue Cross Blue Shield's been pretty good for us, but they have a 3-month rule. That's tight, very tight, especially if you're in the middle of AEP. Cigna also had a company there called Cigna Health Spring. That Cigna Healthcare, they have a 3-month rule. Aetna has their own rule where they actually have to approve it through their Aetna, board of review. It's been very flexible though, but Aetna's been one of our strongest carriers supporting succession planning. And all the carriers say to us, if you contract as an agency and not as an agent, it's going to be much easier for you to transfer your block. Much, much easier because an agency can exist outside of a person. A corporation can exist whereas a person might die. So it makes it a lot easier. You also want to make sure for whoever's trying to clean up your mess or take care of the succession that you have a list of all of your carrier passwords, all of the logins by product line. If you have a Medicare login versus a Medicare Advantage login versus group health versus other Affordable Care Act plans, you need to have all of those logins for each area. And we all know that a lot of the companies will have multiple logins. This is really important. I had an agent that did this. He created all of his passwords, had it on his laptop. He was suffering from terminal cancer. His son calls us and says, hey, my dad died and he had your card here and said to give you a call so that we could get his business transferred over. And we said, sure. And the son could not get into his dad's laptop. His dad had everything in the laptop and failed to give his son the password to the laptop. So that took 2 or 3 months to break into this laptop. And in that time period, he lost half of his block's value, got taken up as house accounts by the insurance companies. Crazy. Well, let me tell you this. Let's watch the next screen. One of the most frustrating companies we've had to deal with on this is United Healthcare. Great company in general, one of the #1 companies in America, but they do put out guidelines. They put out guidelines as though they're trying to help us with transferring blocks. And I get that, but really I think it's more of a covering for them because they've got a lot of rules that other companies don't have. For example, your renewals must be over $2,000 annually or they're not going to transfer it to anybody. Okay. The eligible successor agent may be able to take over a book of business when United Healthcare is notified within 60 days of the death, and the agreement is completed and submitted within 90 days of death. So what happens when somebody dies? You got a get the death certificate. You got to, grieve. You've got to bury them. You've got to make funeral arrangements. You've got to do all sorts of things, selling the house. Who's going to remember within 60 days, oh, I got to call United Healthcare to save dad's block of business or mom's block of business. But on top of that, you can only transfer a United Healthcare block one time. So if it had already been transferred from the dad to the mom, for example, and now it's going to go to a son, no, only one time. But also the person who it's being transferred has to be licensed and ready to sell on all of the lines in the same channel. If not, United Healthcare is going to take all of this block of business for sure. Now, the maintaining it afterwards, you should be incorporated as a agency, not an agent. That's what they want you to do. A lot of people are still set up as agents. You want to be set up as an agency, and you want to be able to prove to them, if they ask questions, that you actually have the ability to manage that block of business, because they do not have to transfer it to you. There are some other rules. If you'll go to the EDC agent guide, you'll see updates, and they do about every year update these rules. And it's been one of the more frustrating companies where it's most likely that a block gets taken away quicker than the other insurers. That's been our experience. Now, so to get started doing all of this, it's really great to want to do all these things, but then you got to put the plan of action in place. And this is really good, that as you decide to do these things, you need to have a plan A and also have a plan B. If you get in bed with somebody and your friend Bob's going to buy your block of business and then he fails to, well, you've lost a lot of time and energy, and you might have already potentially lost some of your block of business. So you need to have a plan B just in case. So it's good to have at least two people that have the ability. You might want to talk to your FMO as a backup plan, just in case your original plan A does not go through. But as you get started on all this, you have to have a confidentiality agreement. You have to keep things confidential. There's a lot of HIPAA violations and Privacy Act violations, high-tech violations, all sorts of stuff, contract violations, if you don't do a proper confidentiality agreement. Part of that confidentiality agreement then will be a letter of intent. Hey, here's our letter of intent. We intend to buy your block. This letter is actually to show the insurance companies, to keep them away from the block, to say, hey, don't interfere with the sale of this business. We're working on it. Don't come in here and snake this out from under us. We're working on it. So it also has, on that letter of intent, has a number of things such as negotiations, and you're going to audit, and you're going to finalize a purchase, but it's going to set a closing date. This is our goal, is to close this block of business by whatever date. And you want to have that in there, final date. So at that point, you want to then pull your entire book of business, both things. You're going to complete a digital database by pulling out your entire book of business from each carrier. Also, your commission reports from the last 12 to 24 months, because your book of business and your commission reports are completely different. If you're not auditing those two against each other, you're missing out. We see a lot of missing commissions that we reclaim for clients. And then you have to set up AOR transfers. Agent of record transfers are prepared but not completed. So you prepare these things so that when you go to the closing table, you sign the AOR transfers for the carriers that allow that, and you do those things at the closing. Just like when you're buying a house, you have to sign a lot of things. Well, there'll be a number of things that you'll be signing, and you have those prepared ahead of time because they need to be signed on the closing date. So these are all things that we know how to do. We were happy to share this with other people. But if you go to a closing and you don't do all these things, you might have an invalid closing, completely invalid. So a confidentiality agreement, what's protected under a confidentiality agreement? It's your acquisition timeline. It's your emergency succession, so that if somebody actually dies during the negotiations, what happens then? Natural negotiations, we're going to be naturally negotiating and trying to figure this worth of this agency and block of business out. Or if somebody says, hey, we don't want to sell, we want to manage over time, then you could have a management agreement. You evaluate the business, and then you decide on acquisition methods. We're going to go over that in an upcoming screen. But let's talk about what the confidentiality agreement especially does. It tells what is protected and it makes sure that you're HIPAA compliant. You have to prove to somebody, if they came in and challenged it, that you are compliant with HIPAA. Is it unilateral or bilateral? That's a legal term. That means, is it apply one way or does it apply both ways? So it applies to both you and the seller and the purchaser. That means it's bilateral, that these rules apply to both of you. You both are going to keep things confidential. You both are going to behave, agree with the agreement of the policy, of the agreement. Now, how long does the agreement last? It's not open-ended. It'll have a specific time frame. You can't do it for 5 years. You say, we're going to do it over the next 6 months, something like that. You identify that. And then what are the permitted usages and disclosures? Obviously, you've got to disclose your client list. You've got to disclose some of your business intellectual property and other things that you have to put in there. Now, all the documents that are shared have to be returned and destroyed, or destroyed if they're not returned, so they cannot be kept. Somebody can't keep your client list. They can't keep a thumb drive with all of your clients. No, they have to return those. And if they don't, what is the penalty to that person? If you find out that somebody you are negotiating with good faith kept some of your client list, what is their penalty? That is theft, and that is legally actionable against them for sure. Okay, so the timeline, different timelines are an emergency sale. Emergency sale, somebody's just had a stroke, somebody's just died. That's an emergency. A natural sale would be somebody saying to my friend, he was dying of cancer, but he says, I might live a year or 3 years. I don't know, Keith. Well, that was a natural negotiation over about 6 months. He never actually finished his succession agreement, but he had his intent and we were working on it. Some people just say, Keith, I want to organize everything up and I want to work on this over the next 1 to 3 years. Well, you don't set up an acquisition agreement at that point, but you might set up an emergency succession agreement. If somebody's saying, give me a year or two, let's organize everything. Let's get all of my commissions audited. Let's get everything done. And I'm going to retire when I'm 80. I'm 78 now and retire in 2 years. That's okay. That's what I call the long haul, where somebody is trying to make good plans. But those plans sometimes fall apart because a stroke or a death or an accident happens, and you need to have an emergency agreement in between. So what is an emergency succession agreement? This is your business will. The business will means, just like when you have a personal will, it tells people what to do with your business. But if you don't have a personal will, the probate court comes in and the government doesn't steal your jewelry and your car and your home. The probate judge comes in and distributes your assets to certain people, maybe your heirs or other people that they can identify. If you die without a business will, no, the carriers take all of your blocks of policies as house accounts. So you have to have a business will. That's the emergency succession agreement. You have to have it. Otherwise, poof, your business is gone. I see it all the time. And this is a national shame to me that agents suffer this. We need to fix it, but it happens every day. So who runs this? In this business will, it says who runs the business. Is it going to be, identify your successor? It explains who that is. And there are 4 things, the 4 Ds that we deal with in the emergency succession. It's death, disability, disappearance, and disinterest. Death, disability, disappearance, and disinterest. If you die, there you go. There's your will. If you're disabled, we need a will. If you are missing in action and we don't know where you are, your business is going to be absorbed as house accounts if you don't have something in your will that says what to do in case Keith goes missing. And then disinterest. What if Keith just doesn't want to do this anymore? Who knows? I've heard stories of depression, anxiety, other things where people are just disinterested or unable to run their business. So you have to put that in there, and that's good for your family to be able to know what to do with your asset. Who's going to own the policies? And then remember, in this agreement, if you don't do it, time lessens the value. So the more that the people have to scramble and fix chaos, the more that people have to step in, figure out passwords, do all of this ridiculous stuff that is unnecessary they could have had prepared up ahead of time. You lose your business. It gets taken as house accounts. One carrier might suck up all your policies. A couple of other carriers might be more gracious, but you're going to lose value of your agency. I see it all the time. So what is a natural negotiation? Well, a natural negotiation would be saying, hey, let's be business people here. Let's figure it out. Let's work out a time frame. understanding that you can't do certain things during AEP. Let's target dates. Let's make sense. Let's get things organized. And also part of those national negotiations might be, are you bringing on some of the employees or agents from that other agency to your agency? The exiting the business is the next phase. And then the succession phase is where you have the actual closing date with funding arranged and all the documents are completed. So the exit the business would either be you saying, I am going to retire on this date, Keith, or there's a trigger in case there's some other thing happens like a stroke or an accident. So people ask me, what is this thing about managed over time? You know, I have a friend who tried to sell her business and it just became a nightmare. It became a mess. And she wasn't selling to me. She was selling to a major player that was trying to acquire other blocks, and it just became a giant mess. And she backed out of the agreement. And she says, I've got PTSD. This has really been traumatic. She had to work an AEP that she did not plan to work. And she said, you know what, Keith, can you just manage my block while I decompress and get over this PTSD from this horrible situation that I just went through? And I said, absolutely. We can have a business agreement, and I'll be happy to allow you to work part-time at your own leisure while we manage your existing block. We manage your AEP, triaging clients and making sure that their reviews are done. And then if you decide you want to sell, we can talk about that in a year or two. She says, that's perfect. You have to have a proper business agreement in order to make this HIPAA compliant, and you have to make sure that you are protecting both sides so that there are no problems with information sharing or referral business, policy writing, all of that kind of stuff. You want to spell that out in your agreement. So business valuations or evaluations. There's two different ways to look at this, but you're basically evaluating a business's quality. You're making sure that that business is well run and what type of business it is. And then some businesses are run better than others. Some businesses, for example, under Medicare, might be direct mail based. Other Medicare agencies might be referral based. There's all different expenses and types of client acquisition. Some businesses are run from somebody's home. Some have brick and mortar locations, etc. So all of those things will be looked at. But one of the biggest things right up front, and everybody knows this, is you look at the revenue. Well, so many of these big companies say, we want to know what your EBITDA is. We want to just know what your earnings are, after those, is net versus gross revenue, et cetera. And it's the easiest way to evaluate a business is to look at the gross revenue, because you might absorb a block of business and you're going to convert that way that business is run to your model. So you look at the gross revenue and say, what would I do with this gross revenue? Other larger companies, hedge funds and other ones that are buying these blocks of business, a lot of times don't look at it that way. But on a smaller block, that's the easiest way to look at it. And this is very important that you look at expiring or volatile lines of business that affect the gross revenue. Are there a lot of ups and downs in the revenue, or is it a very steady stream of revenue? So we'll talk about that a little bit further. Operating costs. What about office expenses, staff, taxes? Are all taxes paid? Nobody's got a bunch of chargebacks coming, anything like that. And then commissions and renewals. We're going to talk a lot about this. Very much important. Persistency versus sales. Persistency is huge in this calculation. All right, so let's talk about commissions versus lines of business. And this changes all the time. We just got another commission increase on Medicare Advantage. You can get all sorts of bonuses every now and then on Medicare supplements. You might get bonuses from your FMO. Drug plans, we just got a big increase. But on this chart that I'm showing you, this shows you an example from a couple of years ago. But as you can see, this changes over time. And that can also be factored into the value of the agency. If you know they've got a certain number of these type of policies and there's going to be a national increase in rates, you're going to be able to calculate that in there for future value of the block of business. But let's look at this. 5 Medicare supplement policies sold in 2015 might have given somebody $2,400 in revenue in 2015. But 7 years later, in 2022, those same policies might only pay out $400. because on the 6th or 7th year, under most Medicare supplement contracts, you have a giant drop in commissions. You go from this 22 or 24% down to 4 or 3 or 1 or 5. And it's a huge drop off. A lot of agents don't calculate that. And when you're buying a mature block of Medicare supplement policies, you better be paying attention to the age of the policies. Advantage plans, they pay lifetime commissions. There's a big difference between first year and renewal years. But again, you make your money and then it's a lifetime payout. So you have to calculate that properly. And then also under drug plans, it's the same way. You get more the first year and then you get a lifetime payout that's level on the drug plan. So you have to evaluate each line of business separately. Health insurance is completely separate from this, but I want to give you the Medicare examples. So let's talk about commissions and how that affects this business valuation. So some examples here is you have to look at each line of business. I'm going to talk about 3, Medigap, Medicare Advantage, and prescription drugs. That's important. But let's just talk about this in general. If you, on this chart, this is just showing you if you had 100% persistency, if you actually kept all of your clients. And you're not going to. I had a guy tell me one time he keeps all of his clients. And I said, no, God takes away some of your clients. So, clients will be lost naturally through death. A lot of times through AOR changes, or people are rewriting them, or they become dual eligible with Medicare and Medicaid. Carriers sometimes steal our clients from us. Change of address, sometimes you lose a client. So, but I'm just assuming on this chart you have 100% persistency. But let's look at Medigap. Big deal. From 2015, if you wrote back there, 5 Medigap might be worth $2,400 in 2015, but in 2022, it's a huge drop off because under the Medicare supplement contracts, almost all, not every one, but almost all, have a severe drop off on the 6th or 7th year. So if you're buying a mature block of Medicare supplement policies, you better investigate the age of those policies. So earlier I talked about some blocks of business that really weren't saleable. It's like this. Find out that they got a bunch of old policies that are getting ready to drop off on commission, or basically the clients are, getting near death. Advantage plans are different. They pay more the first year and then they pay a level commission lifetime. Hopefully they'll never change that. And drug plans are the same way. So you got to calculate these separately, but we are getting a nice bump, a decent bump, 6%, I think, under Medicare Advantage next year on our payments and under the drug plans. That's very helpful. And when you're evaluating a block of business, you can factor that into future value if you wanted to go ahead and assume a 5 or 6% increase in those commissions coming up in the years forward. Let's talk about some other things that help you to acquire blocks of business. If you were approached by someone that had a big group of policies, they were buying a big agency that had a ton of group insurance, had a bunch of dental insurance, had a bunch of PNC and all this stuff, and then they had a Medicare block. And they don't know what to do with that Medicare block. You could do a joint venture. You could say to them, hey guys, buy all this other stuff. The same date of closing, I'll write a separate check for the Medicare block and I'll take those over. You can look for people who are buying other larger agencies that happen to have a Medicare block and peel those off separately because they don't know what to do with them and they might not want them anyway. So a joint venture is good because you might not have all the capital you need to buy maybe the whole thing that you would like, but you can buy a certain portion. Talk to people, talk to your friends about it, saying, hey, I heard you're buying so-and-so's business. Can I buy the Medicare portion? Because I'm the Medicare guy. And you'll be surprised. I've heard people actually being very successful at having a joint venture. That's one acquisition method. It really does help to have friends and be compatriots in this. So let's talk about what affects the seller and what affects the buyer. So I have people that tell me, well, my business always generates this amount of revenue and it always does this amount of things. Once you sell your business, all that future business is for your buyer. You can't calculate all that stuff in there. It's over. Unless you have something special, some special sauce, or some rock solid agreement with some service, you cannot count that going forward. So the seller is affected by that inability to replace lost policies. They say, well, we're always keeping our revenues going strong. Well, it's because you're always writing new policies. Well, the buyer gets affected the other way, is that they get affected by the older policies and the commission changes over time. The seller also gets affected very well by tax situation. When a seller does a true sale of a block of business, they then get a great tax situation. On the first approximately $500,000 is 15% long-term capital gains. After that level, anything above there is taxed at 20%. So you do get a really good deal, better than ordinary income tax. The buyer does get to, write off parts of the business over time, but that's ordinary income tax on all that revenue that they're taking in. So the buyer's getting affected by that. And hopefully, President Biden had talked about changing those long-term capital gains. Hopefully that will not get changed. The big thing that affects the seller is they have to make sure that their buyer is actually ready to sell. Is the buyer able at closing to actually come through? So I'm dealing with that agent that I told you about earlier that had PTSD where her sale of her business didn't go through. It's because the buyer was not truly ready to sell on all lines, and they couldn't transfer the block. It was getting ready to be a mess, and she pulled out at the last minute. On the buyer side, there's a lot of compliance issues. If you don't do these things right, you can be out of compliance. You can be violating contracts. You can be violating commission sharing rules and other things. You've got to be really careful. The seller has to make sure that the buyer actually has enough capital, make sure that they're good there. And then the buyer also gets affected by ex-employees. If a seller had an employee that is jilted or thought they were going to take over the business and now they're not, you've got to protect yourself as a buyer from that poison employee. We've had that happen before on one of the blocks that we purchased. And is this transition or sale legally protected for the seller? And all the other issues you have to watch out for. On the buyer side, you have to make sure that the seller does not have violations, stuff that have come back where the carriers might come back and say they did illegal selling, they were doing illegal marketing, or they had some other things that would affect their contract, the ability for you to take over their block of business. You have to make sure that they have no issues there. So here's the 3 payment methods generally people do, and I'll tell you what generally happens. But a family who has a dead, taking care of a deceased agent generally wants a lump sum. They generally want to just cut them a check and let's move on, just like selling a house and other stuff. They don't want to be in business with you very long at all. Or if you are a buyer, you would love to finance it forever. You'd love to finance this business over a long time period. And that is rare. It happens, but rare. What's most likely to happen is the one in the middle, the blended option. The blended option is where you would put a down payment, maybe a third of the purchase initially at closing, and then maybe you have 2 more payments over time. Well, that kind of protects both the seller and the buyer. You can give the seller more money, more value, because you can calculate persistency and the value of the business over the next year or so, and make sure there's not any poison employees and stuff. So it really protects both the seller and the buyer, but the seller's going to get the least or the most discount. Is going to hurt the seller if they take a lump sum. It's going to help the buyer if he can finance it over time, because you get to protect yourself from potentially unknown elements. And the blended option really just is a nice marriage between the two to help both of you out. So this is where agents fail. Agents fail because they don't realize that their policies will become house accounts. The carriers will take over their block in a flash. Okay. Contracting errors. They think, oh, I'm just going to transfer this over to a family member or something, and they don't have things contracted right. People don't take AHIP. They don't know all the rules, and plenty of contracting errors happen. You're going to lose your life's work. Your reputation is probably going to get damaged with your clients. They're not going to remember you as well as if you did make sure that they were taken care of. Ill preparedness. If you do have a business partner and you don't have a plan in place, it's going to leave chaos, or it's going to leave chaos for your family. Either way, your business partner might be a financial planner and you're the Medicare and health insurance person. Sell the Medicare and health off, get that money to your business partner so he or she could buy more financial planning clients. I mean, let them deal with it the way they want to deal with it, and find the right buyer for your block to take care of it. Don't leave chaos. So thank you very much for listening today. You could always call my office. We're in Atlanta, Georgia. The number's on the screen. And we're here to help and consult. But I really think this is a national problem. And I really hope that the FMOs and our national advocacy organizations will actually make this a lot simpler than it is, because right now agents are at risk and it should not be this way. Make sure that when you do create this plan that you also create your succession squad. Your family knows who your lawyer is. Does your lawyer actually know your business? Who's your CPA? Make sure your personal banker understands your business in case they need to talk to them. An appraiser, if you do need a business appraiser, an official appraiser, they're out there. We do a lot of appraisals and stuff, but we're not, quote unquote, an official appraisal business appraiser. A partner, is the partner truly a partner, or is it just a gentleman's handshake agreement? If you actually have somebody consider your partner, you better have an operating agreement with that partner. And if you have a key employee, you want to have that spelled out properly, the responsibilities and roles of that key employee. So thank you very much for listening today. I hope you found something in here that is valuable for you. We will definitely be updating this as the laws and rules change over time.